understanding that, you know, we can't, there I am. Sure. What I was just told I'm too loud. My wife tells me that. She's like, most of the time you don't need a microphone. But as we go through this calendar, we try and lay out quarter by quarter. Some of this is based on timing of things that come with respect to your plan. Some of this is based on priorities that you've communicated with to us, et cetera. But we'll just go through it. So you'll see fiduciary risk and mitigation. That has to do with a number of things that we look at as a co-fiduciary that we, as we look to the plan, and again, we recognize this is not an ERISA qualified plan, but we essentially act like we do on all of our other plans in that fiduciary capacity to that standard. So you'll see there fidelity bond and liability insurance, compliance calendar. You'll see here in second quarter we have what's called the investment policy statement, investment fee policy statement. That's a best practice that we'd like to discuss with the committee in terms of setting forth in written form how you handle your fees, such as revenue share, explicit fees, direct fees, all of those type of things, and have a policy statement drafted on how this committee handles those, and then of course ensure that they're being followed. You'll also notice there under fiduciary risk and mitigation, we have our annual fiduciary conference, April 5th and 6th, that we extend the invitation to those committee members to come and attend, and we'll have a full session of that conference dedicated solely to training fiduciaries on their responsibilities. We'll have providers such as Prudential as well as many others that attend that conference and help share best practices, and again, we want to encourage you to attend there. Plan record keeping, assessment, and benchmarking. You'll notice on there we've got a few different things, but we also know that the discussion around kind of evaluating and benchmarking some of your current providers is one of the things that you'd like us to do, and so we want to have that discussion today a little bit around timing and how to do that. But that would be part of what that entails. And then, of course, as you move down to investment reviews, obviously each quarter we have meetings set, and we will provide a quarterly packet that ties into a reporting suite. Basically, it will tie into all of the criteria for your plan to show, again, prudent documentation and processes that are being followed. Is there any questions on any of the items that are on that calendar? And again, this is really your calendar. I mean, we take the liberty a little bit of going through a draft, knowing that a number of things that we're going to be working on, but are there any of the items that you see that are, again, you'd like to add, or any items that we need to prioritize in terms of which quarter they fall in?
That we may need to modify, that will just go on the calendar with direction after our review.
Yep. Okay, absolutely. So it's really a living document. That document will basically come every meeting and revisit that document. We will also, if we had been on this plan for a year, what we would go through today is at the very far right, we would have a results column, and you'll see that, and we'll come and report for the full year on those number of those items, and you know we measure the plan, we look at you versus your peer groups, and we'll report on those things as well.
I didn't see an investment policy statement adoption or amendment here. I assume that would take place at our next meeting if you have a recommended modification from what we currently have.
So we have a draft today that we wanted to take you through. If you look up in business planning, it's in that first quarter that says implement.
Yeah, I saw that.
So yes, we have a draft today that we wanted to go through with you that would be, I think there's a lot of similarities in your existing investment policy statement. There are some changes that we would be partial to, and we'll take you through it.
So do you anticipate us adopting that at our next meeting, or were you anticipating we'd do that today?
What we'd like to do is take you through it today and give you a chance to review it, and then
so that we would be ready for
be ready for, have your chance for your legal side to be able to review it as well. It's not a contractual agreement. In that sense, so.
Thanks.
Mm-hmm. Okay. If we can take just a minute, as I mentioned, part of our role and services on the plan is we will drive a documentation process for the plan. That is in terms of a best practice and prudent policy to make sure that we're not only have policies in place, but we have documentation showing that those policies are being followed. I'm going to have Lindsay on our team take just a minute, and what we essentially do for you as a client is we will have a master fiduciary file that we keep all the time. So if there's ever a need for whether you have auditors or a need to have documentation looked at, what we would say is we keep a master file. We keep a hard copy in our office as well as a digital copy. And Lindsay's showing you right now the digital file. We call it our eVault, but it's essentially a way for any authorized members of the committee that would like to have access. You'll have the ability to have access to this digital vault. It'll allow you to go in and see the various documents that we keep for the plan, as well as if you need to put things out there, you can as well. So Lindsay, if you'll take just a minute, maybe just highlight a few of these areas in which we keep documents updated and take any questions.
Absolutely. So we categorize them. Okay. Okay. We categorize them into different sections. So we have a DOL audit checklist. We know that you're not a ERISA plan, but we go through the different things that you would need in a DOL audit. So those are all already built out. So we'll be gathering, we're working with Prudential to gather all these documents from meetings and minutes that we have had before. One thing that we have already done is in this education and communication. So we've sent out to Cami a few things, and so they're already uploaded in the eVault for you. Other areas will have the packet. So the packet that you have today is already uploaded, and you could download it if you wanted a digital version. Additionally, we'll have the minutes that will also go into a folder for you, and then you can grab them whenever you need. So the main thing that we'll need to know is just who on the committee would like access to this, and then we can send you the links for that.
You should have all 5 of the committee members plus all 3 commissioners, right?
Okay, all 5 committee members plus all 3 commissioners. We can definitely do that.
How about Mark? You want Mark to have it?
Now,
And
Mark,
Mark.
what
And Mark.
about their assistants? Should their assistants have it as well?
Okay, perfect. Anything you would like to add as well?
As a follow-up from this meeting, what we'd like to do is schedule maybe a 20 to 30-minute training where we can have all of those members that want to have access, and we can walk you through how you log in, how you access things, and how you load them in if you need to. But again, we'll do the lion's share of the work there. We'll keep the file updated. We'll keep it up to date. We'll put things out there as we meet and as we follow up, et cetera. But we want to make sure that the committee is fully aware that documentation is in place as of starting. And I know that you've been good to get us a few things from prior years as well, and we'll take as much as you have and we'll load it in there to give us as long a history as we can. Any questions around the eVault or the documentation process? Let's take just a minute on the investment policy statement. So if you look in your packet, you'll see a tab, number 6, it says investment policy statement. And I think the first thing that we would say is we would commend the committee. You've had an investment policy statement and have been operating under one. We still find from time to time plans that lack that documentation, and we think it's one of the most critical documents that a plan has. In terms of litigation that we do see for ERISA governed plans, it's a very hot topic in that the criteria, how the investments are monitored, how your fees are monitored, et cetera, fall into these type of documents. So the investment policy statement that we have in this packet for you is we have put in here a draft. There is a lot of what you currently have in your investment policy statement that we have maintained in the document. I would say that there's a few things that we have done. We feel like making your investment policy statement a little bit more specific as to roles and responsibilities would help enhance your current investment policy statement. So I'll just take you into, if you go down to, you'll see on here on page 72 in the packet, it lays out kind of the detail for the investment committee. One of the things that we think is important in this policy statement is that roles are defined so that it's there. You can see kind of those things that again, we know this is a draft, so as you read through, for example, the composition of the investment committee and those responsibilities, if there's anything that we need to change or modify there, we're happy to do.
Just while we're there, Tyler, I think one of the things you may want to look at is, the investment committee it says shall have the power to add, modify, or eliminate.
Yeah.
That may be, that we have the power to advise the county commission. I think it's gonna be county commissioners' decisions.
Yes.
Or recommend to them rather than we actually have the power ourselves.
Okay, that was one we actually, as we went through, looking at your current policy statement and ours, that was one that we were under that expectation, but we wanted to clarify today, so thank you. So we will certainly add that language.
One question there, do you have one policy statement for all three plans? Is that the way it's set up?
Yes, and so what we'd like to do is, I guess our understanding is that this committee oversees all three.
Yeah.
In terms of criteria, we would view it all the same, and in terms of efficiency as well. Is that, I guess, again, though, of course, we'll defer to the committee if you'd rather have a practice to have a separate one, we can certainly do that.
Just so the plans is clear that it does cover all.
Covers all
That
three,
would
yep.
be my
Yep.
one.
Is that the way it's usually done in the industry is?
That's the way we do with most of our clients, where they have what we call mirror plans. In other words, the investments are the same, and even though there's three different distinct plans, the criteria is the same and the reporting is the same. So yes, that's how we typically do it and how we see it be done.
Is the committee's function the same over all three of those plans, right? There would be no distinction between any of the plans that you view?
Yeah, would be the same.
Then we would, unless you want to start to dictate different investments in different funds, which I can't imagine why we would, and if your function's the same amongst all three, investment policy statement's gonna cover all three, but we'll make sure that that's articulated in that. I think that's important.
Thank you, Brent. So I think in terms of trying to help maybe an executive summary format for this committee, a couple of changes that we have in this draft is, one, being more specific around the roles and responsibility for you as a committee, as we just talked, but really more specifically for us. In your current investment policy statement, the language is fine and it's there, but it's more general in terms. And we lay that out to be a bit more specific in our investment policy statements with our clients. As you look through the role of the advisor and the investment process. And so those two things kind of go together. For example, one of the things that we are recommending is we'd like to make your criteria, your performance criteria, both your qualitative and your quantitative, for the performance of your investments in your plans a little bit more stringent. We feel like in our 25-year history of consulting on plans that if we have a good process and we can be more stringent and be very good about it, we can help drive better overall performance to participants at the end of the day. And so, for example, if you were to go down to page 74, and you'll see here where it says investment process and performance objectives. And I'll just, as succinctly as I can, state what we'd like to do is your current investment policy statement essentially requires or asks that your investments show up in the top half, kind of middle of the road or a little bit better. We'd like to tighten that up to, we really want to see investments in the top third. And we look on a 3 and a 5 year basis. You have a little more emphasis in your current policy statement to the 3 year. We think it's important that you look at both 3 and 5 year, and basically in the top third and or beating their passive benchmark. So in other words, if we have actively managed funds that are in the plan, we fully expect that we want those to be able to perform above and beyond a benchmark for the additional fee that you pay for them. And so we have that, that's language that we draft and that we would recommend to put in there if they are not meeting that criteria, and that's a pretty high bar. Again, it's got to be in the top third and or beating their peer group and benchmark. So you've got kind of 3 pretty good bars that they've got to meet. They then go on watch status, and what watch status, we've got it specifically laid out here. Again, in your current investment policy statement, the language is a little bit more general around you know, if managers or funds don't meet that, what really happens, and what we're stating here in watch status is really what happens from our end. If a manager doesn't meet those criteria, then Soltis and our investment committee digs in. We will make a visit with that manager, get on with them in person, go through the portfolio, make sure we fully understand, you know, what the issues are, why they're not performing. We'll come then with, to the committee with a recommendation for whether we think to recommend to keep that particular fund or manager, or to look for a replacement. And so that's just a brief example of some of the things, but again, I think as you look at the overall investment policy statement, much of it will stay the same. It's just going to be a little bit more specific and a little bit more stringent on what we expect to see out of the investments in the plan. I know it's a big document, and I know we don't have time for you to spend time to read it right now, and so yes, the thought there is to give you time to go through it, review it, and then hopefully in preparation for our next meeting, be able to look to make any changes and then adopt it moving forward.
But Tyler, you feel like our expectation is that our funds should exceed the benchmark, is that correct? Be above the benchmark in returns?
Yeah, so I think there's two different types of funds, right? You have actively managed, where you have a manager that is, you're paying, so the fees are higher. You're paying that manager for their ability to pick securities that they can put in their portfolio that will add value to just what a passive benchmark would give you.
But is that on a running 3 and 5 year total then?
Yep. So we look at multiple periods, and we'll take you through a couple of other reports called a consistency report, where we look at them not just on those time periods, but on a continuous level as well.
Because previously we were kind of looking at them quarterly, and if they had so many quarters that they weren't performing, we consider making a change.
Yeah. So that's a little bit of the difference there. Is I think we look at it and say we don't define a specific quarter. In other words, hey, if it's been on watch for 2 quarters, then it has to be changed at that point. However, the criteria will be more stringent, and I think we'll be the first to say there's a little bit of art to that. You know, there's managers that, given certain market cycles, it's understandable why they would be underperforming. But again, it's a much higher bar we're going to require them to meet. So there's going to be more of those managers that we'll be looking at and monitoring on a quarter by quarter and monthly basis.
I guess my question would be, how many quarters do they perform low before you'd recommend? You said it's an art, so there's no cut and dry.
And Bill, you can probably help weigh in on this one. So again, we won't mandate a plan that if it's 2 quarters, they have to be changed, again, because there's, you know, the market can cycle through and there's positioning that happens. So it really is dependent. I mean, we've had some managers that we've held for longer than a year, and our patience has been rewarded very nicely. We've had some managers that a change has happened, or they've had a personnel change, and we've changed within a month.
Tyler, maybe a little extra color is what does happen when a manager goes on watch is an immediate call to meet with that manager.
Yep.
And then a further dive, and you'll see every manager that would be on watch would have a write-up done by our committee, headed by our chief investment officer, and typically almost always a call with the manager to understand what has gone on, if there hasn't already been one already kind of performed. So as much as it's not a time period that it's on watch, it's what happens once it goes on watch that is really kind of where the meat is. And the committee will understand who those managers are that are on watch and why they're on watch, and why we would continue to hold them even though they have underperformed, and it'd be articulated in the write-up.
And when would that write-up be provided? Would it be provided ahead of the quarter, ahead of our meetings?
As soon as that manager goes on watch, that quarter that the manager went on watch, then we would provide that write-up to you in our next quarterly meeting.
Okay.
Yep.
So I understand this, and the standard is more stringent, but the final evaluation sounds a little more subjective than what we've been using. Is that correct?
Only in terms of how long, how many quarters. That's one specific detail that we are asking for more leniency on.
I think part of the thinking there too is since we do have those higher standards, for example, if a manager falls into a median level, 50 percentile in their peer group, we don't we recognize that that top third is a high bar, and so we'll try to be, recognize that and give the manager a chance to move back to that top third.
Is there any point where you'd just say, hey, no, this has gone way too far?
Yeah.
All at once, you know, if they fall down to 20% or something, then you say, hey, no, we're not gonna go with this any longer?
Yes,
Something like
yeah,
that.
managers that are, for example, if they got down into the bottom quartile for, you know, that, they would be on a very short leash.
But
Yes.
it's a little subjective how you deal with that and try to make all the measures you're making and
Right.
to make the recommendation.
Part of what we find is sometimes a manager's style will go out of favor for a period of time, and that could be the manager that's gonna, you know, the next year or two or three, could be the manager that their style comes back in favor, and all of a sudden it's, so we've kind of learned that patience can pay dividends over time.
Yeah, and that's a little bit of that art to it. There, I think we look and say, you know, there's just a lot of variables that are there. But again, I think the overall criteria will be more stringent. So in other words, those managers, they've got to just quarter in and quarter out, they've got to be falling in that top third to be able to demonstrate value for us to want to have them in the plan. Are there any other questions?
A comment that this is your investment policy statement, and if that's not how you want it written, then we're open for a discussion. I mean, if there was a desire to say, if a manager goes on watch the next meeting, Soltis comes with a replacement, that's not how we're designed, that's not how we think is the best, but if that's how the committee wants their investment policy statement written,
Yeah.
we would certainly adhere to that, and it's your policy statement. We're here to be an advisor and a consultant, so.
Absolutely. Any other questions around the investment policy statement? So as an action item for this meeting and leading to our next meeting, we'll just have in the notes that for the committee to be able to review, if there's any edits or changes you want to make, we'll be happy to help facilitate those and then look to have the investment policy statement adopted at the next meeting. Okay. Get back to my agenda item. For fiduciary trainings, so I think we'll, just real quick, and maybe Brent, if I can put you on the spot, because I know that everybody's probably getting tired of listening to me talk. But what we do is we have every year we have at least 3 opportunities for clients that have responsibilities over retirement plans to be able to come and receive training for their roles and responsibilities. And maybe Brent, will you just take them through kind of those 3 and how they, you know, the format of them, and just real quickly.
So on February 1st, we had the first for 2018. I believe some of you, if not all of you, were at that meeting.
We had Ralph and Dave were there, and
Okay.
Mark was there, I think.
yep,
And
yes, Mark was there as
so-
well.
So you got some flavor on how the fiduciary training is conducted. We'll hold 2 of those a year. The next one will be in the 4th quarter. And those are typically held in Salt Lake. Not to say it won't occur down here in Provo. We have held some down in Utah County before, where we bring in industry experts to talk about the most relevant issues. This was not only is this just a good idea to do, but it's something that was recommended by the Department of Labor. They have specifically asked in audits, what are the committee members doing to educate themselves, to keep themselves apprised of the most recent up-to-date changes and items in the administration of retirement plans. So those meetings are held during a day, usually 10 o'clock till 2 o'clock, lunch is served. We'll always send you out invitations to those. We highly suggest that you attend if you're able to, and you're.
Do you record those?
We do.
Yeah, webinars
Are those
recorded.
placed on the files that you showed us, or is that a separate link that you send to us after?
So we'll record them, and they're housed on our website, and then we'll typically send out a link as a follow-up after it's done.
And an
we have
action
to
item
get-
could be to send that most recent one out to you if you'd like to.
Yeah.
We can have that sent. We did send it, but it got sent back, so maybe we can retry and get out of
But it
spam.
was too large for your server.
Even just the link?
Well, it also had a
We'll ditch the PDF and send a link.
Okay, because if you could house a PDF in your in your own system, and then after we have the training, we can figure out where to navigate to it, and then,
Yeah.
So the PDF's already on eVault,
Oh,
and then
okay.
I can send the link as well.
okay.
We'll be holding the annual conference on April 5th and 6th in St. George. The way that day usually works is it's a Thursday and a Friday. There'll be some activities engaged with Soltis. We're to be aware that, we can have a conversation about, what that agenda looks like. Those activities are usually St. George-based activities, a hike or something along those nature. That may, I don't know with it being the county, what you're able to participate in and what you're not able to. And so we'll kind of can discuss that offline and show you the agenda, and you can certainly make those decisions on those proper decisions. That night, Thursday night, there'll be a speaker, followed up by Friday, kind of a full day of different training. One thing I'll note, usually the speakers that we bring into that are some of them are very well-known national speakers that come in through some of our sponsors like
Yeah,
Prudential.
So I would just add, to give you an idea, so we'll have about 200 fiduciaries from all over the country that come to attend the conference. We'll have almost, I don't want to say every major provider, but very close to where Prudential will be there, Fidelity will be there, Empower will be there, JP Morgan will be there. And, we bring their expertise. For example, in April, we're going to have Fidelity's their head of cybersecurity for the entire firm of Fidelity will be one of our speakers at the session to talk about how you be careful around your information, certainly around participants and record keepers and what they do. And so a lot of best practices, a lot of roundtable type of discussion. And that's really a great time to come and be able to gather a lot of that info.
A lot of what we do about the investment policy statement, a fee policy statement, and those other documents that we will work with the county on will typically be introduced at one of those. Financial wellness, I heard the Prudential team speaking a little bit before this meeting about financial wellness and what they're rolling out. We love to bring in different record keepers and have them discuss those types of items. That then we can come back to this committee and sit down and discuss best practices, what would work for the county. So we look forward to those once again, twice a year on fiduciary training, once a year on our annual conference.
And again, we'll have more details to you on that, and if you have any questions, we're happy to help work through that. If we can, we'll move to we're grateful to have Bill Wallace as our Chief Investment Officer here to join us today. He'll be part of the team, obviously, for the plan. We're going to have Bill just go through a little bit of economic update. And I guess I will ask that question first. Most of our committees and a lot of our plans will, as we come and talk, they'll have us provide a little bit of update around the economy and markets and some of the things that we see. Bill is prepared to do that today. I know there's a lot on our agenda, so we can take the time and have him take a few minutes on there, or we can just move directly into kind of the investment reports and begin to kind of orient you to those.
I want to know what the market's going to do. So if you could be real
Bill's the only-
specific, that
Bill-
would be great.
Great, I've got my recorder out, Bill. I'm excited to hear this.
So we're grateful to have Bill as Bill joined our firm a few years ago. He's a 30-plus year veteran, which we tease him. He started working when he was 10 because he's only 40. But he has great experience, and he chairs our investment committee. So our investment committee is made up of 11 professionals. Brent and I are both as members of that committee. Average experience on that committee is about 23 years in the industry. Again, grateful for Bill's leadership. I know we mentioned this early on in the process, but Bill just finished serving as the chairman of the Utah Retirement Board and is still an active member of that board. So he still is on the board, but just finished his assignment as chairman, which is a $35 billion pool that obviously there's great expertise that comes. So Bill, we'll turn it over to you take us
Okay.
through the economic.
What I'm gonna do, if we go to page 15, I'm just gonna kind of show you the reports. We have a market commentary report, which is essentially more looking historically, what's happened. Obviously, the markets were very strong in 2017, both the equity markets in particular was a stellar year. The bond markets had positive returns. So the purpose of this report again is to provide kind of a look back The next page, we show various economic indicators, and this tends to be a little bit of both a look back and a forecast of what we see coming forward. So for example, growth, that top box, you know, we think economic growth is gonna be sound, will actually be higher this year than it's been since the recovery. We're looking for 3% plus economic growth. So to answer the question posed, we actually view the activity that we've experienced the last 2 or 3 weeks as a kind of a needed correction. As we look, you know, through 2018, we think corporate profits will be good, the economy will be strong. So we anticipate, you know, a fairly good equity market coming in 2018. The next slide, page 17, just shows a variety of different benchmarks to inform the committee on what, you know, what returns have been in different asset classes and so forth. And then on page 18, there's a quilt chart. We actually, as you know, those of you who are at our fiduciary training, went through this in some detail, talking about how this quilt chart can be used to inform, you know, asset class information. And so these 4 pages are kind of regular pages that you'll see in our quarterly updates. Questions or comments beyond?
Do you ever use this asset class performance as a part of your recommended allocations?
We do,
And how do you
definitely.
do that?
It's kind of like we talked about how, for example, the top performing asset class for the last 3, 5, and 10 years is large cap U.S. stocks, growth stocks. And to us, in kind of a contrarian way of thinking, is maybe some other asset class would be, you know, the star in coming years. And so some of those that are more at the bottom of that category, that would just be one area that we consider, but it is a thing that we use as kind of a way to help us try to figure out. It also is designed to send the message, though, on the calendar year returns, the difficulty in actually figuring out what's gonna be the next, you know, I mean, that's what the quilt chart, that's why it looks so messy, is because who knows what's gonna be the best asset class in 2018.
In terms of our investment committee, we look at this data. We're fortunate with, you know, we have about $3.5 billion of assets that we advise and manage to, and so we get great access to research from so many of the great companies in this country, and we leverage that as a committee to look, and then yes, absolutely, we look at how we kind of position in our own client portfolios. For example, one of the things you'll find on the business calendar is to kind of review your goal maker portfolios. We have a number of clients that they have us drive the allocation in that for them, because we'll be a little bit more active than your kind of traditional record keepers. And we've worked very well with Pru. They have a really good platform for it. They do a good job in those portfolios, but that's something to discuss, and we can go through. But yes, in terms of our investment committee, we'll look at this data, and then we kind of work to position our client portfolios accordingly based on some of the risks or some of the opportunities that we may see in the market. Any questions specific to that data or economic that that the committee has or would like to pose? Or if not, we'll move forward to the plan investment review, and you'll find that under a tab that says plan investment review, starting on page 19. And this tab and this section will basically take you through the entire reporting suite that we generate and we'll bring on a quarterly basis. So every quarter we'll generate this entire report. Have this, I think it's important to note the criteria in terms of documentation. So the criteria that is stated and will be eventually adopted in your investment policy statement, whatever that criteria may be, if it's different. But what we'll do is we'll build these reports to tie directly into that criteria. In other words, so every quarter when we come, we can look at these reports, and whatever the criteria is that we've set in your investment policy statement, these reports will tie and correlate to it so that we can monitor the investments as we go through them. You'll notice on pages, starting on page 20, We've given just a plan asset summary of each of the plans. And so you'll see that on page 20, 21, and 22. As we continue to work with you over time, what you'll see is we'll actually chart these over time periods. For most of our clients, it's a 6 or 12-month look back, and what we're gonna do is kind of watch the allocation of your plan. We wanna try and help understand if you have employees that are perhaps chasing certain parts of the market, or if you see a big flow from cash into emerging market equities or something like that. Those are things that we want to be aware of and know, so that as we talk and communicate with your participants, we can. You'll also notice that there's a weighted expense ratio that we calculate, so it gives you an idea, and that weighted expense ratio is based on obviously the investments and then the actual allocation, or how much weight they have in each one of those funds across there. So you see the 401k plan on page 20 at about just under 103 million. Under the 401A plan, just a little over 35 million. And then on the 457, just a little over 22 million. The page 23 it gives you kind of a succinct report card of the criteria in the investment policy statement. You'll see that up there on the top on that quantitative scorecard, 3 and 5 year performance versus benchmark index. It's got to be greater than or equal to the index over both of those periods. And in that top third over there on the right, kind of laying out the scoring system. So it then lays out, how those, if those criteria are not met, is where watch status comes into play, and so we're looking at those. And then right underneath the quantitative scorecard is you'll see the qualitative data, and this is a little bit of that art that we talked about, but these are a number of the qualitative factors that we're looking at with each one of the investments in your plan. So we're looking at lead portfolio manager, the firm strength, we look at the firm, we look at tenure of the manager and experience, how stable their team is or their organization is, investment strategy and shift. We watch very closely if we have a large cap value manager, we expect them to be a large cap value manager, and if they begin to all of a sudden become a growth manager or kind of change their stripes, that's something that we want to know and watch carefully. Of course, we think each of these managers has an important kind of spot in the plan in terms of a participant that wants to build a well-diversified portfolio. Risk-adjusted performance is a critical one. As human beings, our kind of natural inclination is, right, when we pick our investments, we just go and look at far right corner and which ones perform the best. We also want to understand how much risk those managers are taking. And that's an important metric that we look at. On expense, I think this is an important one to hit. You'll see here what we want to see investments as part of the criteria that are at or below their category average. In other words, a small cap manager, we want to look at the investment expense of that option, and typically we like to see and utilize managers that are either at or they're below the average fee that their peer group is charging. We think fees are important and an important one to watch in terms of overall performance.
Tyler, one thing I'll add is the benchmark. So we don't decide, Soltis doesn't go in and decide which benchmark is used by that fund. We'll go to the prospectus that's filed, a legal document that says this fund benchmark is XYZ benchmark. And so we're not cherry picking a benchmark and trying to manipulate the data in any way, shape, or form that way.
Who does make that decision?
The fund company that makes that decision. And if that fund company were making changes to that, we would have serious questions on that if there were, but usually when a fund is established and the prospectus is completed, they will dictate, we're a large cap growth manager and our benchmark therefore needs to coincide. We do reserve the right to come to the committee and say we feel like that benchmark is not correct. That would probably give us more concern over the fund if that were the case, though. What we do want to watch out for, as Tyler mentioned here in this, the investment strategy shift. If we have a fund that says I'm a large cap growth manager, and all of a sudden we look and they're buying, a lot of small cap value managers, or small cap value names, stocks, that would give us reason to be concerned with that fund as well. So, but we wanted to just make sure that you realize that we're not going in and saying, well, let's use this, let's back test the data, and this fund will look good versus the S&P. as opposed to the Russell 1000 value, that we're gonna go off the prospectus.
What we want to do now is, and I'll have Brent kind of help us do this, but we want to just orient you to, we have reports, what we call our scorecards, that are again built specifically to this investment policy statement criteria. And we'll start with the consistency report on page 24, but Brent, are you fine to just kind of take us through and just, we want to just orient you to, what we've done is we've actually taken all of the investments in your plans, we have run them through and done the analysis based on the criteria that we took you through earlier in the investment policy statement draft, to give you an idea of where they fall and what it looks like, and then just to take you through the reports. We actually do have one recommendation today is in terms of fund change. It's a pretty simple one, and I'll just hit that one real quick on page 24, and then Brent can take you through this. You have an index fund. It's called the Dreyfus Midcap Index. When you're indexing, your biggest thing is fee. You're trying to say, look, I don't want to really pay a fee. I want to have low expenses. And while Dreyfus is a good shop, their index fund is at 50 basis points. And Fidelity has one available through Pru at 5 basis points. So it's 10 times cheaper than what you're paying now, and you're getting the exact same index.
It's not one you've highlighted in yellow, right?
Correct. It's not. The indexes, because they're never going to beat their benchmark, they don't fall under that IPS criteria. In other words, they'd always be on watch status, or they wouldn't, and we'd report them all the time. So a passive index basically is taken out of that criteria because they're always going to be at the benchmark minus the fee that they charge.
So essentially, if you look at that, their average excess return is a negative 0.53%. Their fee is 50 basis points. So essentially, if you start using the Fidelity fund, that average excess return is probably going to be a lot closer to zero.
Are they providing revenue sharing?
Does Dreyfus? They
Yes.
do.
Is that why this is the way it is?
To some extent, but not, that's part of it,
Not the full 50 bips.
but not the
basis
full 50
points,
bips.
But is it a equal revenue share if we switch to the one you recommend?
It will drop a little bit because the Fidelity one does not. You only have about 250,000 of assets in that fund, so your revenue share will go down a little bit in making that change.
Okay, I'll walk you through the first report here, the investment risk and tolerance, investment risk and performance consistency report on page 24. We begin the report obviously with cash and equivalents, and as you go down, we move assets from the most conservative to more risky, with the target date funds being the exclusion there at the bottom. We just put the target dates at the bottom. What you do is you get the fund, the ticker for each fund, which is the identification mark for that fund, the dollar amounts that are invested in the specific fund across all three plans. You then see the calculation benchmark. So I'm going to pick on Invesco Growth and Income, R5. That's the benchmark for that fund is the Russell 1000 value. And then Tyler spoke just briefly a minute ago on the quantitative status and the qualitative status. The quant being that 3 and 5 year versus his benchmark and its peer group. The qualitative being those measures that he outlined, manager tenure, and those other items. You then see the recommendation that Soltis has. The average excess return, we take these managers and we take them on a 10-year time period, going back 10 years from the last quarter. And then we look at them on 5-year increments. So 5 years, then we go back a month to 5 years, back a month. So we actually end up looking at a 5-year number 61 times. 5 years going back 10 years, shifting by a month. Any questions on that? Sometimes people scratch their head.
Yeah, I guess you have under your recommendation, it's an acronym or something. I don't understand what it is.
Yes.
It says R, FS.
So let's go to that.
CKX.
That R is a replacement. And so for the Dreyfus midcap that Tyler just spoke on, it's replace. We're recommending a replacement, and we're recommending it with the FS CKX, which is the Fidelity index, midcap index. So that's the fund that we would like to replace in the lineup. If you go to page 35,
Real quick on that, the
Yeah.
second one you have on there, the Clear Bridge, that's a fund change that you had already approved and is still in process right now. So we're just reflecting it in the report that that's gonna
But
happen.
even with your criteria, it was meeting at least a watch, you know?
The
Clear Bridge was on
Clear
watch.
Bridge, yes, they were.
Because
They
this
were
is
on-
your new criteria
Yes.
versus what we're
Correct.
dealing with.
Correct.
Is that clear, Ralph, then what that recommendation column is? And the fund that we would recommend to be replaced. On that, just for going, for future meetings, if you go to page 35, when we're gonna recommend a replacement, we're also gonna provide quite a bit of detail on that fund. So you can see on page 35, what we do is we take the Fidelity Mid-Cap Index that we've recommended to be added to the portfolio, and we've taken the Russell Mid-Cap Index. You have the Dreyfus Mid-Cap Fund that is currently in the fund lineup. And then we take the whole universe of US fund in the mid-cap blend space. So we have all of the active funds there, an index, the fund we recommend, and the fund that we recommend replacing. And then you can see all kinds of different data points on that. In the bottom left-hand, you see a qualitative review. You can note here, in that box, it says prospectus net expense ratio. You see the 5 basis points for the Fidelity Index that we recommend replacing to the Dreyfus, which is at 50 basis points. Any questions on how that will look going forward? This, like we said, is a very simple change. If we were gonna be replacing one of your active managers, there would also be a write-up done on the manager, why we want to replace the manager, and there'd be more information provided on the new manager that we're recommending. And there could be kind of a discussion on that and why we feel like that's the best, and then we would ask for, that would be our
If you-
recommendation.
Brent, if you go to page 30, for example, we've done a write-up of the JP Morgan Small Cap Value Fund that's in the menu lineup. So that's an example of what Brent's talking about. We also did a write-up of the Clearbridge Small Cap Fund, which is on, let's see, I guess it's.
Page
35 or
32.
Yeah, page 32. So, as we essentially agreed with the move to move out of that manager, and then as we were reviewing documents, we realized that you guys had already done it, so
Did-
we've just noted that.
Are you comfortable with the replacement also?
Yes.
Yes.
Yeah,
Okay, so I'd like
it's a,
to
it's a
point
good
out,
team.
Go
Sorry,
ahead.
go ahead.
sorry, 2 items. I do not have confirmation that the Clearbridge small cap growth was approved on a commission agenda. I cannot find it anywhere. I have emails from my department requesting it. That was a week that Mark was in attendance, and I don't have any record that it was actually approved on the commission agenda. So what I would like to do is,
We'll just check, because I thought it wasn't on the agenda.
I've gone through everything,
Maybe-
but
maybe not.
Okay.
if it has been, we'll move forward with it. If it hasn't been, then we'll make the recommendation for both.
Right. I believe in talking to Kelly, I'm not sure Prudential if there's Kelly in your team. I know when we communicated, it sounded like it's in process. So in other words, I'm sure that process can be, I'm guessing we could stop it if we needed to. Or just push it out.
Yeah, either way, whatever's needed.
Would you like us to try and put a hold on that? And,
We can let you know.
Yeah, we
Okay.
can let you know by the end of day tomorrow.
Okay.
But we would like it.
It's not as important with non-ERISA plans
Yeah.
because you don't have the ERISA participant notification deadline.
Yeah.
So it's a little bit easier to do that than
Very
using
true.
for time to get the letters out, but, yeah, we certainly can do that. And then I just wanted to mention one thing on this quantitative report that, on the fixed income, you have the Prudential Series Government Money Market Fund. They actually have the guaranteed income plan on it. So I just thought I would point that out, so you guys can make sure you-
That's, I believe that's down below on page 25. That's the target, no?
No, that's the balance fund. So I
That's
think
the
you just
balance.
have a money market fund instead of guaranteed income. I just thought I'd point that out, so it's right in the record. So they have our spread product guaranteed income, and then if you guys would like, Tammy would have gotten the, interest rate for the
Okay, yes, we would.
And I can send that to you
That would be great.
as well. I just asked Carol to look it up first.
Okay, yeah, that would be great. In our feed as it came through, we actually questioned that as well. So
No problem.
thank you for bringing it up.
I just wanted to make sure it was
Yep.
reflected correctly, so going forward.
Okay.
We'll make that adjustment.
Okay, we'll send that over now.
Thank you.
Just a quick question. I'm trying to compare your watch list versus the ones we've had in the past. And it looks like the Clear Bridge was on both. The JP Morgan small cap was on both. The difference is that you have JP Morgan mid cap on watch, where before we had the Barron Partners on watch. Can you kind of assess what the difference is? I mean, what your feeling is, why it's the JP Morgan mid cap versus the Barron that we were looking at before?
Maybe we can start with page 38, Tyler.
Yeah.
If we go to page 38, I'm gonna introduce you to another report that we use. And this report is pretty straightforward. We're gonna look at 1 year, 3 year, 5 year, and 10 year on the quant side. So on page 38, if you go down to the Barron's Partner Institutional there, Ralph, you can see, well, once again, the assets, the calculation benchmark, which is mid-cap growth. And then you go, it obviously gets a check mark because we do not have it on watch. And so at the 3 year, this fund has returned 10.31 versus 10.3 for its benchmark. The blue is the fund's return. The gray is the benchmark return. And then the 3 year rank, it's in the top 35% of its peers. If you look at the 5 year, it's outperformed by its return has been 17.04 versus 15.3, so pretty good outperformance. It's in its top fifth of its peer group. We would have to ask for the data and what the watch criteria was for. I can't understand unless you were looking at a very short time period, or
Well, I don't.
to
Under the
us,
old
that comes
system-
through with a pretty nice report.
On the old system, they were scoring at a 6. I don't know how that compares to what you've done here.
Well, this is a bit of a hunch. Their 1 year number is strong, really strong. And my guess is that 3 year number looked a lot, looked less attractive a few months ago.
And if they were basing it heavily off of 3 years, that could have
Yeah.
been on watch at that point.
So, but it's a really good question. If you take maybe a minute, this kind of illustrates why the consistency report on page 24, the reason we do this report, and Brent explained it well, is rather than just look at a 3 year number and just update it each quarter, is you're taking a picture and you're just looking at that picture, kind of going, how good does it look right now? And the reason we do the rolling, we had to actually create this report ourselves, is because it kind of allows us, instead of looking at a picture, to start to look at a cartoon. We get to see them moving, right? And so you get to see, because a manager may have a really good year or a really bad quarter, and they'll look terrible for a few quarters, and then all of a sudden that quarter falls off, and all of a sudden the picture looks all rosy and nice. And what you're not seeing is, well, I'm not really seeing the entire picture. So, for example, if you look at the Barron's on this report, you'll see that they've been very consistent. Their average excess return is about 92, almost 1% better than the benchmark. And then if you look at them month after month like we're doing, you'll see that 73% of the time, almost 74% of the time, they've beat the benchmark. So that's one of those where my guess is if you look at their 1 year number, it was really strong. And a few months ago, that 3 year number probably didn't look as strong. But that's why we go to the, and Lindsay's probably gonna smile because building this report is, it takes us a lot of time, but
I
that's why
think
we
it
do
was
it.
the first time on the watch, if look at my minutes
Yeah.
are correct, so.
And we know, we actually know Ron Barron and that team, and that's a well-run fund.
So I'm gonna finish this with the investment consistency report with a few more items. This will be a report you'll look at every time, so if we can get a good foundation. The excess return is what we'll do with those snapshots that Tyler just explained, the 61 snapshots that we look at multiple time periods. We'll take those and we'll average the return above the benchmark. So looking at Invesco, actually, if you look at Invesco growth, it has underperformed its benchmark for those 61 time period, an average of those 61 time periods. It's beaten its benchmark 36% of the time. Its up capture is 97.2, and what that up capture means is it looks at its benchmark, and when that benchmark is positive and moving up, how much of that up is it capturing? So, for example, on this Invesco, if the Russell 1000 is going up, it's only moving up at a 97%, capturing 97% of that upward movement. And then on the downside, how much is it capturing when the benchmark is moving down? So ideally, what you'd like to see there is you'd like to see a fund that captures 100 or more of the upside and less 100 less 97, 95 of the downside. And that would indicate a very good manager. I'll tell you now, Invesco is a fund that we're gonna kind of have a little more due diligence done on. We have a manager, Oakmark, that we actually put some information in this. We've not come with the recommendation yet because this is our first meeting, but Invesco does not score out well on our consistency report here, and may be a fund that we look to replace in the future. But we're not prepared.
Well, we knew that today would be the first time to be able to introduce the criteria to you and wait for that adoption to take place before we begin to operate under it.
This is a proprietary report here, developed internally at Soltis, that we've calculated these numbers. And like, I think Tyler explained it well, instead of one picture, it gives us 61 pictures that we get to look at and see if there's any consistency. That helps us in that watch decision. So when a manager goes on a hard snapshot of a 3 and a 5 year and it's failed, and it should go on watch, the next report that we look at is that consistency report to understand, has this manager, how has it done over the longer time period? And has there been time periods where he has underperformed? We've seen many managers go on watch and come off watch, and we're very happy. Barron is a good example of that. It kind of had a tougher 3 year number. We could go in and probably highlight why that is, and we'll do at future meetings. But based on trailing 1 year, the county's very happy that it's continued to have that. It's nice outperformance over 1 year.
I know you're all thinking, if this is the type of movies that investment consultants watch, they must lead very boring lives, which we probably do, but again, helpful for us in terms of how we really evaluate a manager as best we can.
So, and then Tyler, on page 38, you just see, we've already looked at this briefly, but we don't want to just focus on the 10-year consistency report. We do want to give you an as of the last quarter report, hard report, 1 year, 3 year, 5 year, 10 year numbers. And then on page 39, you start to see the qualitative report, and where it doesn't pass. I'm going to pick on Barron's. So if you come down on page 39 and look at Barron's, it passes its qualitative status. It is fine on the qualitative, but it does have a failure on the Sharpe ratio. So if we were to look at that, we'd look at the Sharpe ratio of that versus its peers, and the Barron Fund has had a little bit more volatility than its peer group has.
And potentially, that could be part of the reason why your previous advisor put it on watch, is perhaps they felt like it was taking too much risk for the return.
Those are the main reports that we provide there. Tyler, is there any more color, or the committee any more color that you'd like, any questions? We don't expect you to have this memorized. We'll bring it again next time, and any questions we'll freely answer and go through, and hopefully after enough time you'll be as comfortable with this report as we are. And so,
Like, as we emphasized already, it's a reporting suite that all directly will tie into the investment policy statement criteria that eventually is adopted. So from a prudent process standpoint, it's very sound.
I'd maybe mention one other thing. There was, and this is maybe part of the forward-thinking recommendation, but we're wondering if you should put a 2060 target date fund on your menu. Right now, if we go back to
page 25.
Yeah, you have
the last one, the last target date ends at
2040 and a
2050.
2050. So that's just something to, as a heads up. We're not making a recommendation today, but thought that the 2060 fund might make sense. as a target date.
Any employees that would be 25 or younger that get hired in the next few years would technically fall more to a 2060 portfolio than a 2050.
And eventually we'll add a 2070 fund. We'll just continue as these time period goes on. My hair will be a little grayer, and but we'll add a 2070 fund.
So right now, we've recommended the change to the Clear Bridge small cap, which is going to go to commission for approval, or we're going to check to see if it's going to commission. The other one you're recommending, though, is that something we pursue at this time, or do we have to wait until we've changed the investment report?
That one, because the investment
Or
policy
plan.
statement criteria, the performance criteria really doesn't apply to an index option, then it's really just about fee. And I think we would say you're going from a 50 basis point or 0.5% to 0.05, so you cut your fee by about 10 times by simply going in. Yes, you are gonna lose a little bit of revenue share, but
But not the full 45 basis
No.
points. It's
So
gonna be a net.
what's the feeling, Tammy and Dave, or do we act on that today, or make a recommendation to the
Make
commission?
a recommendation?
I have to put on the commission agenda both the Dreyfus mid-cap and the Clearbridge small cap for removal, and then add in the recommended.
Because we've already voted on the Clearbridge, I'm not sure we voted on the Dreyfus, right?
We haven't voted on.
We
the
didn't,
Clearbridge.
as a committee, we did not vote on the
Oh,
Clearbridge.
we did on the committee, yes, to make.
I know the
recommend-
commissioners
I
did.
understand what you are saying now.
Yeah.
Okay, yes, so we would need to make a recommendation and vote.
Right, a question there, though. So you say, does it have any revenue share at all?
no, the Fidelity
The
one will.
Fidelity does not.
So
Do you know
how
what the,
that- so
do you know
how
what the
that
revenue
works-
share is for the Dreyfus?
I'd have to look it up, I don't know.
I wouldn't expect you to.
I'd be good if I did. But just to refresh everybody's memory, how the revenue cap works at Prudential is that we have a required revenue, and then, we until, I know we talked about fee levelization. Right now, we share revenue, correct? So at the end, so soon, like within the next couple of weeks, we will be getting what we call a true up, and then we get that revenue disclosure that says we have X amount of dollars either in excess or that we would need to invoice for any revenue that was not driven from the funds. Historically, we've always had some excess in various amounts.
Sorry, I just realized you're not being recorded, so
Oh,
you need to.
so we have a revenue cap in place that we have a, required revenue that we collect. We do something every year at the end of the year called a true up. So what that does is it looks at what revenue do we collect as a whole? What does Prudential need to keep for the record keeping revenue? And anything extra, we would refund back to you. Anything that, if the revenue had fallen below what we require for record keeping, we would send an invoice. Historically, your plan has always had an excess in various numbers, but it's significant. So I wouldn't guess that we'd lose enough revenue in an index fund.
Yep.
That it would make a difference, but I certainly think by the time you get your approvals, I can have that information for you, so you would know what the difference is.
My concern there is, I think our goal is to move to where we don't have any revenue sharing at all.
Yeah, that's what I
Fee-
understood.
Fee levelization.
Right, and that's fine,
Right.
and again, that's fine,
So
so
it's
what,
just
so the
fee-based
difference
only.
would be, you can go to the zero revenue, it's just would lower, either if you had a refund coming back, it will lower that amount. If it's so significant that you would move out of a fund that shared a lot of revenue, you could potentially be in an invoice situation. So
Yeah.
that's the only difference when we start moving out of funds when they're sharing revenue to going to a zero revenue share. And that's fine, because generally what happens when you move to that zero revenue share, it's how you end up, charging your participants. And then our record-keeping requirements are the same until we, go through RFP and decide to change them. So you will just have to come to some number that's going to cover the expenses of the plan as well as your record-keeping expenses. So I think we're,
I understand that, but my concern is until we make that switch with all of our funds, if we do it piecemeal, such as the one we have here, this fund, then anyone in that fund now is not contributing any revenue to the expenses of the
correct.
plan,
That's correct.
whereas currently they are.
That's correct.
And so while you have a recommendation that I think is the right thing to do, if it's the best non-revenue sharing fund, I think that change ought to occur at the same time as all the other fund classes go to that same status.
and the only other thing I wanna bring up, cause Cammie asked me to bring it up too, and as we talk about fund changes, we also have to talk about the expense of what it costs to mail a fund change mailing, because that is something they do not have currently in their, pricing is, because they're not ERISA, we don't do the mailings for them, cause they're not required by law to do them. So right now, this Clearbridge mailing, this fund change, We have in the past always mailed the letters, but it is $1.50 per participant to mail the letters. So if we're gonna be doing fund changes every committee meeting, that is going to and you want to do the letters, then you have to, account for that
Yeah.
expense.
You've charged $1.50 in the past for all the
Mhm.
times we've made change as well.
And could we put 2 changes in one notice?
Yes.
Okay.
You'd want to consolidate those
Yeah.
best you can. So I think that speaks to your
wait.
point, Dave, that,
Yeah,
So-
so my point is if we're,
Yeah,
the way we want to move is to where there's no revenue sharing, which is gonna change a lot of funds.
so I think
So
too.
we have to do
yeah.
that one time instead of piecemeal, so that's only one expense. And then everyone, again, shares the burden equally.
Yep, so it kind of goes back to our business calendar, second quarter, we have that fee policy statement, which is to specifically state how you handle revenue share. And so, yeah, we can wait and do that. I think in talking with Kelly, we know that this plan has historically had excess revenue share, meaning on this particular change, we looked and thought with 250,000 in there, we made a little bit of an assumption of, hey, there should be there's been excess, you're getting more than enough in revenue share that one change. But your point's a really good one, which is those participants then all of a sudden are not contributing to the
participating with cost.
overall, yep. So we can just put that on hold, and we have a second quarter to kind of go through, and the fee policy statement does exactly that. It goes through and we'll go through with you essentially and say, this is the ways in which ERISA has kind of said it's okay to handle revenue sharing. And it's going through each of those fee levelization and making a decision, and then showing how you document, this is now the process on how we handle that revenue share as it comes in.
So are we able to hold off sending this
Yes.
notice until second
Yeah,
quarter?
absolutely.
Okay.
But what I'd like when you do that, if I could, is to come back and say, this is the way these are all the funds we
Yeah.
recommend under this new fee, no revenue sharing
Yeah.
proposal.
Yes.
and we'll conduct what we'll do is conduct a share
Yeah.
class analysis, and we'll go through every share class that's available for that specific fund. There may be upwards of, I've seen 15 share classes for one specific fund. That's uncommon, but I've seen it. And so we'll
What's the
come back.
timing on doing this?
So this is on our second quarter, so our expectation is to come next meeting, in that next meeting to come with a draft of that fee policy statement and go through it with you as a committee to help make the decision as how you want to handle that. And we'll have that analysis done at that time to kind of take you
At
through
that
it.
time, we can make a recommendation to the commissioners, and then these other changes could take place
Yep.
at the same time.
And they could
Yep.
go under one letter.
Yep,
And then the conversation could be had and maybe you've had it, we're new, so sorry. Around, is there a way to email some of those notifications?
Yes.
Um,
If we have email addresses?
If we have
yes.
email addresses,
Yes.
those can be emailed, and then we could, the ones that you don't, but most county employees probably have emails, and so can we be
Yeah.
sending that out via email to save some costs there, especially if that's a hard cost to the plan, not included,
And
so.
Kelly, do you have to mail that even to the people who only have $5 in the system?
has to go to
So-
everybody.
The answer is yes.
Or $1.49, so we lose a penny on it?
Yeah. Yeah, you are a non-ERISA plan, so theoretically,
You don't have to.
you don't have to do any of this, right? Theoretically, you can post something on the intranet site, because of your status as non-ERISA, you're not gonna be audited by the Department of Labor. However, alls I can say is, in the 6 years that I've been on the plan, we have done things per ERISA
Yeah.
to kind of just stay, out of that
We
litigious.
concur with that, but just wonder if maybe if we could look at an email list to save some
We
costs to
can
the
do
county.
that, and that would
The
save.
only other thing though is that I just want to just forewarn when we do the email and we don't have all the email,
Yeah.
is that it is your responsibility then to make sure that you get them mailed to the people. We won't do email and then send mailings. We'll
Okay.
do one or the other.
One or the other.
So it would be, then fall back on the county to go ahead and mail those to the participants we don't have emails for.
I have go ahead.
You'll want to talk to me about it.
I just wanted to clarify, those that have signed up for e-delivery of notices, Prudential will e-deliver those notices to them at no cost. So we're only gonna mail the hard copy for people that have not signed up for e-delivery.
Would you be
That's
able to
on the
provide
purchase.
us with a list?
I'd have to run a report, I don't know off the
Okay.
top of my head, yeah.
But you can run that
Yeah,
report and show us who.
They can provide a report of who's on that, who's opted into e-delivery.
Okay, yeah, if we could have a report of that, then we can just
We get more to
relook up and.
opt in, tell me.
Save some costs.
And then my question would be, are you holding off on the Clear Bridge too, or is that something you're gonna move forward with because of
We would
when you
hold-
approved it?
You'll know by
We would hold
tomorrow.
off, well, I think you looked and I looked and we don't have the approval.
I didn't look closely.
Okay. Yeah, we'll let you know by tomorrow.
But we may decide to hold off and do them all under
Correct.
one letter and one operational issue.
We could have a meeting, and we could call another meeting, we don't have to wait for a quarter. I don't know how quickly it would take you to get ready. Do you have recommended new funds and,
Couple weeks.
Yeah,
I mean, we could,
And I like that idea of saying, well, let's just have one meeting just for a share class analysis. That's a big item that the committee has wanted to look at, to know rev share, and we could prepare a share
Yeah.
class analysis.
the precursor there is just the adoption of the investment policy statement and that specific criteria. Because
Yeah.
that then says this is the criteria in which now we're operating. So we'd want to have that, in place. But yes, we can certainly, it'd take us a couple of weeks and we can,
yeah, well.
we could go through
we
that.
ought to do. No need to wait for a quarter, just
Okay,
be able to do that.
we'll take that as an action item to do.
Because I think we pretty well made the decision, that's the way we want to go, we're just waiting for new advisors to come on board.
Okay.
to do it.
Kelly, I know I promised you 20 minutes,
Alright.
and now we have 4.
All right,
But just in terms of timing, I think, would it be all right if we want to make sure with Kelly and Carol out here that they've got the Prudential just plan metric report to kind of go through. And then if we can either at the follow-up, maybe take a few minutes on the education component, and do that, just given our time today. Does that work? Okay.
great, thanks. So, okay. Is that okay? Everybody has the book though that's on the committee, correct?
Do you not have?
Another book?
on your
Yep,
computer.
I have a couple of them.
Just one would be great. Thank you, Kelly.
Did you say you do or don't have a presentation?
We don't, she doesn't have it up, or,
Oh.
Tyler has it, but we didn't really coordinate very well this time, so.
I can email it to you.
Okay, so while they're getting that going, why don't we go ahead and turn to page 4, and we'll just talk really quickly about the plan assets year over year, from 2016 to 2017. I have them broken out by plan. The 401K plan which is the 415 plan, has moved from 85,540,094 to almost $100 million in the plan alone. And probably if I would have looked it up today, it probably has gone over $100 million. So congratulations to the county for that milestone. Then we have the next plan, which is the 416 is the, again, I'm confused, the 401A plan. So that's the plan that is currently frozen to new participants. That has moved up from 32 million and some change to about 34.5 million. And then we have the 457 plan that is a little over 20 million, has moved up to 22.2, almost 22.3 million. So we've got some growth there, and we can look at on another page what that means from assets in versus just market change. And then the committee does always like to see how many participants are in each plan and how many are participating in multiple plans, and even up to all 3 plans, so those numbers are there as well. I don't go over this every time, but I would like to just look at the very first on page 8 on the dashboard, just so you can see where the plan has gone, and this is just the 401K plan. Since 12/31 of 2015, there was just under $80 million in the plan, and again, it grew to $85.5 million in 2016, and again, we're just about at $100 million as of the end of 2017. So there's some nice plan growth there as well. We'll go ahead and move to page 13. This really is the demographics of the plan. Year over year, we've grown in participants from 1,217 to 1,257. We have 980 participants at the end of last year, with 272 terminated participants. Both those numbers have grown just a little bit by about maybe about 25 in the active participants and about 10 in the terminated participants. We did have more suspended participants in 2017, and just to refresh your memory, suspended participants are those who take out a hardship withdrawal and cannot put any more dollars in for 6 months while they're under their hardship withdrawal provision. Average account balance for your active employees has grown from 75,842 to almost 83,000, which is a nice growth. The median balance for those active participants is about just about $50,000. A new stat that we're adding in here so we can kind of talk about participants and retirement readiness is how many people do you have over the age of 50? And currently we have 510. And we have over half the plan assets are sitting in those demographics over the age 50, about 60 million. So that is something that sometimes we talk about, how to target those participants to make sure that they're prepared for retirement.
Well, on that issue, I know a couple of meetings ago, Kellyanne, I'm not trying to interrupt you. We talked about you and the NFP and Prudential getting together an education program for the pre-retirees, which I think we need to turn over to you and Solstice
Right.
at this time, because it
Yeah.
never happened, so.
Yeah, so we had talked about that, I think, right before the decision was made, or right around the time the decision was
Yeah,
made.
it's back in August, yeah.
So what we've been talking quite a bit, probably since mid-September, about how Solstice would like to move forward with participant engagement. So we do have quite a few different options for you to talk about what Prudential can provide. The financial wellness program that we're getting ready to launch will help with a lot of that. We won't spend a lot of time on it today, but I'm going to leave you some brochures to look at, and then we can schedule some time on the next meeting to talk really about where financial wellness is going. And then we'll make sure we cover that too as well, Ralph.
Soltis has a retirement readiness seminar scheduled for March 21st. That's just one of the, we hold about 3 a year.
Okay.
That's not designed for Utah County, but we'll invite Utah County employees that want to come to that. I'm not saying that because maybe you have a large enough participant base that we'd probably like to customize something specifically for the county, your own meeting. But that is something that we have coming up that we could send to
It's
you.
already been sent to all of our employees.
Gonna say you're,
Jeez.
yeah.
More
Lindsay's
people
there and
have
you're-
already signed up.
I'm a day late and $1 short, but
Good.
we do have that coming up, so.
Good, good.
Now you guys know why Lindsay's here. She gets our stuff done.
That's good to hear. Cash flow reports kind of talk about this is where you'll see where your market value change has really affected the plan. We had just about 6% of market value change from 1/1 of 16 to 12/31 of 16, but the market value change in the plan in 17 was 15%. So that's just assets going in from the market getting larger, which is good for all of us, right? So time, Cammie, how much we got?
We have a half hour,
Oh, we do still have a half hour.
yeah.
Oh, okay, sorry, we had until 4:30.
Oh, okay, great.
Till
We do have some
4:30.
other meetings too.
We do have a closed meeting, that's true.
Okay, so let's just go ahead and, for the sake of time, look at page 14. And this really kind of talks, this is what I call my speed, kind of my speed reading report, because it really talks about a lot of the different pages we could go in depth with on the plan. So the first one is our goal maker. Talks about, goal maker is the qualified default status vehicle for the plan. So the plan assets we have in goal maker currently has grown quite a bit from 29 million in 2016 to 36.5 in 2017. We've got almost 37% of the assets, excuse me, not the assets, the participants in goal maker. So that's really from 523 in 16 to 616. And then we have a participation rate of 49%. So really about half the people in your plan are using goal maker. Now it sounds like you guys are gonna be looking at the advisor goal maker program, which you're gonna be tweaking some of the allocations as well.
Potentially, it's just a discussion.
Potentially,
Yeah.
yeah. So, that probably would help some of, we could certainly drive and do some communications around that as well, because generally when you do that, you expand the allocations within goal maker, allowing you to have more of the funds that are in your plan exposed to goal maker, which is nice, because you have that rebalance feature, you've got the risk feature.
And you've got the getting older, conservative glide path feature as well. So Income Flex, this is something too that, you know, possibly we could do some more, maybe emailing and some awareness around. Income Flex is your guaranteed income stream product that you have within the plan. It has stayed pretty steady at about 47% of 47% of the 16 people that are in it have about 47% invested in Income Flex. So it's a little misleading, but it just means that of the 16 people, approximately 47% of their assets are in the guaranteed income stream product. So the participation rates, it's lower. I think maybe it's lower because you guys also have a state pension that you can fall back on. So the average book of business for Prudential is 6%. So that's just a place that we could potentially do some more educating around. We have some Roth assets in the plan as well, and that's grown from $864,000 to $1.3 million, which is nice. So with some growth in participation as well, from 8.9 to 10.9.
Why do you think our Roth numbers are so low? Because we have a more mature workforce, or?
Probably, yeah. That would be one of them.
How long has the Roth function been
It's been in a
place?
while.
Has it?
Have you been talking to people about Roth?
We have on the new hire meeting, we talked, and there is a lot of discussion, new hire meeting about Roth.
Do they know that it defaults to the 401k and not the Roth?
In the, on the match, yeah.
Okay. But they can change it to a Roth.
Sure.
I'm
Well,
just saying
no, well, the match will always stay
in the 401.
in the 401k side.
So we do talk about, to the employee, about how they can actually physically
Okay. So then, we're gonna just skip down to the stable value fund. It just talks about the participation rate. It shows right now at 72% of the participants are in, and a lot of that has to do with Goalmaker because stable value is one of the asset categories in Goalmaker. But then the plan percentage is just at 20%, which is a little less than what the average book of business and the national average is as well. So we'll just go ahead and look at, sometimes we had talked about loans, so we'll go ahead and just, we have about $1.33 million out in loans. There was only an increase of one loan, 77 to 78. We have less outstanding loans at 269 with about 21% of the people in the plan taking loans. So that's just some good awareness there. The only other thing I really wanted to talk about today is just some of our participant engagement, because it is the end of the year and it kind of talks about what are people doing and how are they engaging in looking at their, their retirement on their own without us coming out and doing education or Dick doing education. If you would turn to page 21, we'll just go over the retirement income calculator. So if you're familiar with the website and you go out to our website, there is that green bar that sits on the left side of the participant website, and that's called the retirement income calculator. And this has been very successful to get people to understand what kind of dollars they're gonna need in retirement because we gauge that monthly. So the middle line on the first box up there is unique completion. So we had 249 people go through, which is, about a quarter, a little more than a quarter of the people in the 401k actively go ahead and take that quiz. The difference between the 249 and the 357 is it means that over 100 people went back in and said, hey, this didn't calculate right because I know I'm gonna not have a gap in retirement. So of those people, they went back in and gave it more information to make it more realistic for them, because you can add Social Security, which can be an issue here at the county if you've been here a long time. You can add your spouse's income, any investment income, any other source of income that you have that you're gonna be able to count in retirement, and that's probably what most people did. But the big number I want everybody to see is almost 100 people from that 249 increased their contribution just by using that tool. And so it's a really valuable tool. We won't, for the sake of time, again, look at all of the stats below it. But the one thing you will notice is the average contribution rate for the people that go through it versus the people that don't is generally higher. and then your gap and your surplus generally is higher. There's usually a bigger gap than a higher surplus. So that's really good information as well. We'll work on a whole comprehensive education and communications campaign with the new, with Saltus, and kind of see, from a financial wellness perspective, I do have, this is just really introducing financial wellness to you. It's not even it's really kind of a white paper. It's not a Prudential sales pitch. It just talks about why it's important. And we launched a financial wellness tool last year on about 100 clients. And it's very successful that Prudential really has taken it on as really their corporate mission is to have all of their divisions of Prudential feed into their customers' financial wellness from a holistic perspective. So this financial wellness tool that we called it last year is actually going to be our new participant upgrade on our website. So as we move forward, we'll work with Soltis to take a look at what that interactive tool can do, how it works for you. I know in their book, back in their communications and education, it does have a one-page overview of our wellness tool that we're using on our new participant website to give you a little inspiration how we came to it, and then we can even demo it next meeting if you'd like to see it. But it will just be available for free. There are some vendors out there that are doing financial wellness, but they're charging. As a Prudential client, you get it free of charge, and it will be the participant website. The other thing is, coming in April or May of this year, we're also offering Student Loan Genius, which is a tool that helps kids coming right out of college to consolidate their loans, to get better interest rates, to look at how they can manage their dollars better, and that's generally a charge to most people. It's a product you buy. We're offering that for free.
That's awesome.
So that'll be on the web, April or May, it'll be available. The only thing it won't be available on the website for free is if you want to use it as a non-elective contribution and help your employees pay down their loans. Most employers aren't quite there yet anyways, so we decided just to offer it as a free service for your millennials that are coming out of college that need some help with that. So that'll be available as well. Does anybody have any questions at all? I know it was kind of quick.
Sorry, you just said something that switched in my mind for me. So, Student Loan Genius, if an individual comes out with student loan debt, they can put their repayment and get the company match to their student loan payment. Is that correct?
Well, theoretically, you can do that through Student Loan Genius. That's not that's not what will be available.
So what will be available then?
Will be all of the consolidation, lowering their interest rate, looking at other ways to manage the debt. Right now, and I can't say we won't have it, but right now, and even some employees wanted us to payroll deduct it for them, so they can say, hey, we have Student Loan Genius, and I want to take $200 out of my paycheck and pay my student loans, and they payroll deduct it. The participant website won't have that capability either, but it'll be more of the modeling tools, more of the things to help them keep it all kind of set. Lots of tools that will say, you're not putting in your 6.2% because you need to pay off your student loans. How can we help you drive a payment that's good for you so you can save for retirement too? Now, if that's something you're still interested in, some of where you called it a match, but it's really a non-elective contribution. You can't really match them theoretically. It's supposed to be a non-elective, but it is things we can discuss, and it is something that's still available. That does just get charged back to the plan though.
It's something I discussed with NFP last year, so I think it's something at least.
Yeah, we can leave it on the
accounting
out on your
should
calendar.
they decide to move in that direction.
Yeah, absolutely. Yep. Any other questions?
No.
Thank you for your time.
Thank you.
Okay, so I think the last thing to do is approve and set a date, time, location for a closed meeting to discuss the character, professional competence, or physical or mental health of an individual or individuals for today's date at this location, following the completion of the regular agenda.
So moved.
Second.
Okay, I have A motion and a second. All those in favor say aye.
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 All right, then we will conclude this meeting and we'll move into closed session.
Okay.